Anyways, let's go ahead and get into the first topic for today. Intuit CEO warns of tax bill shock for Bitcoin and NFT traders. Let's go ahead and knock this one out. So basically, this is coming from Bloomberg. Americans are increasingly investing in speculative assets. The regulations around Bitcoin and NFTs remain murky. And this is an important thing to note because when we're talking about cryptocurrency and taxes in general, I know a lot of people struggle. I get a lot of emails and a lot of questions surrounding like, who can I hire? I can't find anybody to hire. No tax attorneys, no CPAs in my area, no accountants in my area want to work with cryptocurrency. And why is that? Well, it is because, of course, the regulations surrounding it are not really created or stable at this point. So you're in kind of this gray area as far as taxes go on what you report and how much you owe and which asset class changes here or there. Mining's a little bit easier. I did do it last year successfully, and that was essentially just going to be income tax on Ethereum. And part of the way I was able to successfully do that was with an application called Bitcoin.tax. And I did basically make sure that I had pulled out a lot of ETH so that I didn't have to calculate capital gains on top of that. But it gets really kind of difficult. And I think that there is some validity there from, of course, this article as far as that is concerned. So Intuit Incorporated Chief Executive Officer Sasan Goodarzi warned that Americans who invested in speculative assets like Bitcoin or non-fungible tokens and actively traded equities on commission-free websites could be dumbfounded at this year's tax bill. Quote, we're going to see a lot of that throughout tax season where folks just didn't understand what they did. And there's a lot of millennials that really did a lot of trading without knowing what the implications are, end quote. Goodarzi said in an interview. They are shocked as to how much money they've lost or how much money they owe because they were in essence gambling with their money. Now, we could go into the differences between gambling and all of that and like purchasing cryptocurrencies, but I understand that's pretty close. You know, on this channel, like as we talk about, I'm a lot more interested in revenue generating assets. I don't really tout purchasing a lot of coins. And that mindset is because I feel like just purchasing coins doesn't generate revenue, and therefore it's more akin to gambling than if you are essentially trying to either buy GPUs to mine because you're adding some sort of contribution to a network. So that has value there, right? That's why we kind of base everything in cryptocurrency around that proof of work kind of consensus mechanism. Or, of course, you do have the options even still for staking, etc., to generate revenue in that way. You also have DeFi, decentralized finance, and the liquidity pools that you can add to generate revenue, and that would be another revenue generating basically option. My question would be, of course, how does mining differ from liquidity pools? And so liquidity pools on DeFi and staking, because at this point I'm not actually really clear on that, and once I get a better answer I'll let you guys know. Because do liquidity pools fall into the same bracket as mining where you pay income tax on the generated revenue from that? Same with staking. Is that how it's going to be perceived this tax season? I'm not too clear on that yet. Maybe you guys know in the comment section, but I think there is a point here where if you did a lot of trading, and I know I haven't even looked at all of my 1099s yet, but I know I'm not going to be happy, right? It's going to be pretty brutal, I think. It does look like The government's leaning heavy on applications such as Coinbase and Crypto.com to help manage and retrieve some of those taxes, because I know they're sending out their own 1099s, etc. So it's going to be interesting to see what those say in comparison to what, a tax attorney or an accountant says compared to what a CPA says. How much of that, as miners, one of the big things that you need to be keeping a track of is the GPU purchases, and then of course filing those out for depreciation. That sort of thing is going to really save your butt when it comes to taxes, especially when we're talking about the income tax for mining and being able to write stuff off, right? Because it's going to function a lot closer to a business than trading does. Regulators have signaled they are preparing to act aggressively to ensure those who purchased NFTs are taxed appropriately. However, there remains some confusion over how the sale or purchase of tokens will be evaluated by the IRS. For example, NFTs, which give buyers the rights to digital images, could face a tax rate as high as 37%. Now, I don't know if that tax rate is part of the bracketing or anything along those lines, but 37% on an NFT is pretty insane, if you ask me. Of course, it does make it even more akin to like laundering practices to me for some reason. Like, it definitely legitimizes it if it's going to be taxed that heavy. I hope you enjoyed this clip from the Crypto Mining Morning Show every Monday through Friday, 7:45 a.m. Pacific and 10:45 a.m. Eastern Time. You can check out more clips here, or if you're interested in checking out the entire live show, you can check that out down here. Thanks for watching, and I'll see you next Tuesday.